Support for today's episode comes from Amazon. Amazon is working toward a carbon-free energy future, doing more with less, investing where it matters most, and supporting communities where we operate. Visit the link in our show notes to learn more about Amazon's spotlight on energy. Energy contracts are entering diligence that ignored them. Power availability, PPA terms, and energization commitments are becoming more consequential in transaction and underwriting decisions as electricity constraints affect asset value. Agreements once negotiated purely for operating reasons are increasingly read by acquirers, lenders, and insurers who were never part of the original negotiation. Corporate energy agreements have traditionally been negotiated around operating needs: price, supply, reliability, and emissions goals. But as power availability becomes more consequential to facility expansion, data center capacity, and capital deployment, those agreements are increasingly relevant to people who were not part of the original negotiation. Acquirers, lenders, and insurers are looking at power commitments through a different lens. Whether the contract preserves value, transfers cleanly, and supports the assumptions underlying a transaction. Power availability is now a line item in deal pricing. Power availability is already influencing data center valuations. S&P Global Market Intelligence data cited by Data Center Knowledge show 113 completed data center transactions globally in 2025, worth more than $69 billion, with facilities that have reliable power access commanding higher valuations as grid constraints limit new capacity. Separately, according to data from Synergy Research Group's chief analyst John Dinsdale, private equity firms have consistently driven the data center market, accounting for 80 to 90% of total closed deal value. This investor rush propelled the total value of closed data center-oriented M&A transactions to a record-breaking $73 billion in 2024, far surpassing previous years. Yuri Struda, senior research associate at S&P Global Market Intelligence, added an important qualification. Constrained power is shaping site selection and new development, but it does not necessarily shift how acquirers perceive the value of an existing asset or the risk of a deal, because most acquisitions involve single-site, already electrified facilities or operators whose locations already have power committed. That distinction matters. Power availability is increasingly evaluated alongside location, capacity, and expansion potential, but the clearest effect so far is on which assets look attractive and which locations get built next, not a wholesale repricing of every completed transaction. Insurers are pricing power risk into deal economics. IMA Financial Group's Q1 2026 Energy Insurance Market Report found that emerging power and data center development are testing traditional underwriting models, citing grid stress, long equipment lead times, and contractual energization milestones as factors elevating exposure on integrated construction to operations placements. The report goes further. It specifically identifies misalignment among OEM, PPA, lender, and EPC agreements as a common source of uninsured exposure. And it states that quality due diligence integrates insurance and risk engineering before deal pricing is finalized, with poorly structured programs expected to show up in the price itself. The underwriting scope is widening beyond traditional property and business interruption questions. IMA's emphasis on contractual energization milestones and cross-agreement alignment puts energy contract structure closer to the center of insurance diligence than it has historically sat, even if insurers are not yet underwriting the specific commercial terms of a PPA the way an acquirer or lender would. The change of control clause, nobody reads until it matters. Corporate transaction guidance on power and renewable energy, M&A, has started flagging PPA assignment and change of control provisions as a distinct diligence category, not a footnote inside a broader contracts review. Pillsbury's 2025 data center PPA guidance notes that these agreements typically define the conditions for transferring a PPA or undergoing an upstream ownership change, along with obligations to replace credit support and qualifications the transferee must satisfy. A PPA that a target company negotiated on favorable terms years earlier can require counterparty consent, replacement credit support, or satisfaction of transferee qualifications before the agreement can move with the business, which means the contract does not automatically follow the deal, just because the deal closes. The same logic that has reshaped how environmental liability gets priced into transactions is starting to apply to energy contracts. The question is not just whether a favorable rate exists on paper, but whether that rate and the counterparty relationship behind it survives the ownership change the deal is designed to create. Power agreements are becoming part of the financing package. For power-intensive projects, energy arrangements are increasingly intertwined with bankability. Lenders evaluating data center and generation developments are not simply underwriting the building. They are also evaluating whether power is available, whether key contractual milestones align, and whether the counterparties supporting long-term obligations have sufficient credit strength. Pillsbury notes that project finance providers backing generation behind a PPA pay particularly close attention to the buyer's creditworthiness, since developers often rely on that long-term revenue to finance the underlying asset. While IMA separately identifies misalignment among PPA, lender, and EPC agreements as a common source of exposure that does not get caught until a claim arrives. Recent large transactions illustrate the same dynamic from the borrower's side. Reporting in late July on the proposed Anthropic and Nexus data centers financing in Texas indicates that Google's backing would cover 4 Anthropic data center leases and their associated power purchase agreements tied to a 1.6 gigawatt on-site natural gas plant, a structure aimed squarely at reducing the lender's risk on the deal. The direction is consistent even without a universal rule requiring a signed power agreement before any debt is issued. Power arrangements are moving from a project detail lenders assume will work out to a specific input in how a deal gets financed and priced. The contract was never designed for this audience. None of this means every corporate PPA needs to be renegotiated for a hypothetical sale. Most companies are not being acquired, and most facilities are not financed through project debt that requires a signed power agreement as collateral. But the direction is consistent across data center transactions, insurance underwriting, and project finance. An agreement that was written to solve an operational problem, securing power at a predictable price, is increasingly being read by audiences the original negotiators never had in mind. A term that looked reasonable to procurement, sized correctly by facilities, and cleared by finance can still create a problem for an acquirer's model, an insurer's risk engineering, or a lender's collateral requirement, because none of those parties were in the room when the contract was written, and none of them are bound by the assumptions procurement made at the time. That has a practical implication for how companies write energy contracts now, independent of whether a transaction is imminent. Assignment and change of control provisions, collateral triggers, and termination language should be drafted with the assumption that someone outside the energy function, an acquirer, an insurer, a lender, will eventually read them under different pressure than the team that negotiated them. Some large buyers have responded by moving further upstream and taking direct ownership stakes in generation, rather than relying solely on contracted supply, which changes the diligence question but does not eliminate it. For most companies without that scale, the more realistic response is treating contract language as a transaction document from the outset, whether or not a transaction is currently planned. Diligence has caught up to the contract. The contract hasn't caught up to diligence. The broader pattern echoes what has already happened in capital-intensive infrastructure sectors, where execution risk moved from a technical question to a financing one. Commercial viability increasingly depends on whether a project can secure insurance, financing, and creditworthy counterparties, not simply whether the underlying technology or contract works as designed. Energy contracts are following the same trajectory. The people who negotiate PPAs are still optimizing for price, reliability, and operational fit, and those remain the right priorities for the deal in front of them. What has changed is who else eventually reads the contract and how much weight that second reading now carries. A company that treats its energy agreements as internal operating documents is increasingly negotiating for an audience of one when the market has already expanded the audience to include acquirers, insurers, and lenders who were never part of the original conversation. Sustainability Soundbites energy coverage is sponsored by Amazon. For sponsorship opportunities with Environment and Energy Leader, please reach out to a member of our team.